Making Moves Monday on a Monday night. And before I get into my topic, here's a scripture for you. Jesus answered them, "Do you now believe? Indeed, the hour is coming, yes, has now come, that you will be scattered, and each to his own, and will leave me alone. And yet I am not alone, because the Father is with me. These things I speak to you, that in me you may have peace. In the world you will have tribulations, but be of good cheer. I have overcome the world." This is Matthew chapter 16, verse 31 to 33. And my topic on tonight is how to deduct things from your taxes if you are a W-2 worker. So a lot of people I know have been saying, "Hey, you know what? I owe 10,000 in taxes. I owe 8,000, 7,000 in taxes." And all they do is basically work a regular job, and they're wondering why they owe so much in taxes. And that's because in most of these cases, they're making more money than what they used to. And now that they're making more money, the IRS is taking more money from them and saying that they basically owe more money because they're making more money. Now, one of the things a lot of people don't take advantage of when they actually start making more money is different ways that they can get deductions on the money that they're actually making. Now, the best thing to do would probably be to actually start your own business or start buying properties and other things like that. But before you start doing that, because maybe for some of you guys, you don't know about what kind of business you may do or you may run on the side, the best thing for you to possibly do, at least this one, number one, is to get yourself a HSA account. And what this basically is a health savings account. Now, before you actually go and try to get it, you have to check with your job to see if they have a high deductible health plan. So if they do have that, then go ahead and get that, and then you'll be able to get yourself a HSA. But if your job does not have that and they do not offer a high deductible health plan, then you can always go the route of getting one outside of your job, and then you can go ahead and get the HSA account. Now, when you get this, what you want to do is you want to take your money and actually put it into that account, and you can take up to $4,150 a year to actually put in this. And when you put that much in there, this will all be tax deductible. So that means that the money that you put in there, this will deduct what you may actually owe to the IRS. Now, another good thing about this too is that we're in 2025. So people who possibly didn't have it already, they're looking for ways that they can actually deduct money for 2025. So this is a way that you can actually do this, because up until the tax deadline, which is sometime in April, I believe the 13th to, or maybe the 15th of April, you have the opportunity to put that money in. So let's say you go and you're preparing your taxes and you see that, hey, you know what, I owe probably like, I don't know, $8,000, $10,000. If you go and you put this money into a HSA, even right now, and put it marked down for 2024, then you can have some of that money that you actually owe deducted from your taxes, which will lower the amount that you actually have to pay. So this is why I recommend this to people, because even if you're in that situation right now, you can go and use this to your advantage to actually lower your actual taxes. Now, if you have a family, you can put more than that. So I believe if you have a family, it's about 8,000 and some change that you can actually put in to this actual account, where you can actually deduct from the taxes that you may possibly owe at this time. And like I said, you have up until April to actually do this and open this up and start putting money into it. Now, another good thing about this is that not only do you get tax deductible for this, you can use this to actually invest. So you can use this HSA to actually invest, and then you do not get charged on what you actually gain from investing through this account. Another thing also that this account will allow you to actually do is that when you have medical bills, other medical things, or your doctor maybe recommends certain things for you to actually take or do, you can actually use that money to actually pay for those things. So if you have you're dealing with obesity and you possibly need to lose some weight and you need to go to the gym, and you're thinking that you need to get a personal trainer, you can use that money to actually pay off your personal trainer. There's other things that you can do with it, but you would need to look this up with the company that you actually have. And then for some of you guys who already have it and you're not putting a whole lot of money into it, I would suggest that you start putting more money into it so that you can actually use this for tax deductions. Alright, so another thing that you can actually use is your actual retirement plan, your Roth or your IRA. But I would recommend that you use your IRA instead of your Roth, because your Roth will not give you any tax deductions. They basically take taxes up front, and then whenever you take your money out, then you can basically get a tax. You don't have to pay any taxes on that. But with an IRA, you actually do get tax deductions for this when you're actually putting money into it. Now, it's been said that you can put in $7,000 into it each and every year if you're under the age of 50. If you're 50 and above, then you can go ahead and put 8,000 in there. They're trying to make sure that you can get more money in there because you're closer to possibly retiring. Now, it's important for those of you who are trying to lower the taxes that you actually have to pay, that you actually utilize this, because you're making more money, and so the government is taking more money from you. And so you're paying taxes, but it's one of those things, because of the money you're making, the government's going to need a little bit more from you. So in order for you to actually lower that and actually get some more tax deductions for yourself, it's best to actually use your retirement plan. And for some of you guys that do have a retirement plan already, you're not putting enough money into it. So if you start putting more money into it, then you can start seeing more deductions on your taxes. And in the same sense of what I was talking about with the HSA, you can basically do the same thing with a IRA. And what I mean by that is, even though we're in 2025 at this current time, you can put your $7,000 into this account and then basically mark it for 2024. And once you mark it for 2024, then you can use this as a tax write-off. Like I said, until the tax deadline is up, I believe, like I said, it should be sometime in April, somewhere around the 13th to the 15th. And up until that time, you have time to actually put money into this and put it down for 2024. So if you go and you prepare your taxes and you find out that, hey, it looks like I'm going to be owing money and I need to come up with ways to actually not have to pay this, this will be a good route to go. Now, I know what some of you guys may be saying, well, I'm still paying something. Well, yes, you are still paying something, but it's better you paying yourself and knowing that you're going to get that money back when you actually retire. Or even two, you can use this money to actually to make to do loans from. So when you have an IRA, you can actually make loans from it. So in case you do need the money back at some point in time, you can borrow against this actual money and take the money out at a lower interest rate than you would for a regular loan. And then when it comes back up for you to do tax or to have your taxes done, you can do the same thing again and just put this money back in. So this is why I would say it's actually wise for you to do so, and it's even wise even though that you are spending money, the money is going to you and the money will help and benefit you instead of you just giving it to them and having a big hole in your pocket that you won't actually get back. They're not going to give you any money back, and you're not going to be able to borrow a loan from them. So this is another tip that you can use to actually deduct your taxes. All right, so last but not least, now with some of these, you probably won't be able to still do them in this year. You should have done them last year, but you can definitely work on doing them for this year so that you have some good deductions for 2025. But one of those is actually given to a charity. You can use this to actually write off and get deductions on your taxes. So given to your church also too. If your church actually prints up and gives you receipts of the money that you actually put in, you can use this as a deduction on your actual taxes, and this could show that you actually gave. Or even too, when you give to certain charities, they will give you a slip to let the IRS know, or you can use it as a receipt to let them know, hey, I basically gave to this organization and I should get a deduction for that. And then also too, one of the things with your car, wherever state that you're registered in your car, you can use that. And then also too, on your actual home, using your home and utilizing the home that you actually, if you're buying a home, you can do a few things as far as using the interest on the mortgage that you actually pay on your home. This can be a way for you to deduct on your taxes. Then also too, basically if you were to get a home equity loan on your home, you can use the interest off of that as well. And then definitely the property taxes. And then for some of you guys as well, the depreciation of your actual home. If you bought your home, you can basically use the appreciation of your actual home as a deduction as well. I'll probably have to break all that stuff down on another video, but these are some of the things that you can actually still do. But also too, when it's all said and done, they will ask you usually if you want to use the standard or deductions or the itemized deductions. So I believe the standard deduction right now is about 14,000 or so. And then your itemized deductions, that depends on all the things that you mark down as deductions. But I would say that you should try both methods and see which one actually works out better for you. So depending if the standard works better for you, then use the standard. If the itemized one works better for you, then I would suggest that you use the itemized one. And definitely the person you do your taxes with, or what app that you may be using to do your taxes, should hopefully show you that and give you guidance on which one would be better for you to actually utilize on your taxes. But this has been another Making Moves Monday. And then always remember that one move can change your whole life.